1:32. Maybe we get started,
Great.
Tom.
Yeah, we'll get started. So welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today. Our topic is Perspectives on the Path to ESG and Impact Investing for Catholic Institutions. This program is the first in a series that will focus on topics related to ESG and impact investing. My name is Tom Lanctot, and I'm privileged to serve as the Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Astarjan, has done a great job organizing this program and is at the Zoom controls. Enormous thanks to our terrific panel of Catholic overachievers, who you will meet shortly. Today's format will be conversational, and CIS champion and venture investing legend Tim Connors will be the moderator. There will be time for audience questions after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question, and Zayla will compile them and share them with the panel. Our audience is muted. The program is being recorded and will be available for replay on the webpage of our CIS Institute. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit serving other Catholic nonprofits and manage over $900 million of client assets in 4 different strategies. We hope this program provides some useful take-home value. You've received biographical information for our speakers, but I want to emphasize a few highlights. We have a sophisticated audience today, and I think you will agree that our panel is more than equal to the task. After earning degrees from Haverford College and Harvard Divinity School, Alexia Kelley has been a catalyst for a vital Catholic church in the common good. Her significant nonprofit and public sector experiences include important roles at the Catholic Campaign for Human Development, the Environmental Resources Trust, the U.S. Department of Health and Human Services, and the White House. Alexia is an enormously influential and successful leader of FADICA and its efforts to connect, engage, and inform its members so that their Catholic giving has lasting and measurable impact. Not surprisingly, Alexia has been mentioned as a possible candidate to be U.S. ambassador to the Vatican. So be nice to her in case you're planning a trip to Rome. In addition to his day job, successfully managing $2.5 billion in endowment and pension assets for Georgetown University, Mike Berry is true to the Jesuit tradition and a real man for others, serving on the boards and investment committees of several noteworthy nonprofits. Like many accomplished investors, Mike earned his CFA, but also has degrees in philosophy and international studies, probably another reason why he's a good match for the Jesuits. Last year, Forbes magazine included Tim Connors on its Midas list of 100 top tech investors. Tim's Pivot North funds provide early stage venture capital computer scientists who not only want to disrupt important markets, but do so in ways that advance ESG principles and improve the lives of the underserved and poorly served. Tim is a hands-on coach to the founders he supports and applies the same thoughtful and provocative style as a leading Catholic layman. In addition to service to his parish, the Archdiocese of San Francisco and Notre Dame, Tim is an active board member of FADICA and uses his STEM brain for the greater good. CIS has no bigger advocate or better friend than Tim Connors. So before we start our conversation, please join me in a short prayer. And I should have asked, given Alexia's credentials, I should have asked her to offer the prayer, but I need the credit more, so I'm going to do it. Dear God, please grant us the serenity to accept the things we cannot change and the courage to change the things we can and the wisdom to know the difference. Please especially bless all those whose lives have been so disrupted by the pandemic and help those of us who have merely been inconvenienced realize how lucky we are. Amen. So Tim, take it away, please.
Very good. It's an honor to be included today. So Mike, let's start with you. So ESG and impact investing are part of a big alphabet soup. ESG Impact, USCCB investment guidelines, SRI, stakeholder capitalism, inclusive capitalism, integral capitalism, the names go on. Can you just give everybody kind of a level set for a few minutes on what this is all about?
Sure, of course. And really happy to be here, Tom. Thank you for organizing this. And maybe just a few quick points before I get into the level setting as I reflect on our journey. And that's to add the following, that when you're exploring these topics, it really is a journey, and it's an active journey. This is not on autopilot. I think the journey requires a lot of discernment, and it can be equally guided by values and financial decisions. I don't think that those are necessarily at odds with one another, but they are perhaps even equal in weight, at least insofar as we've gone down the path. So for level setting, we sort of categorize this broad field of topics under four main pillars. The first would be SRI, which is socially responsible investing. The second would be ESG. The third is engagement, and the fourth would be impact. The first SRI is really about alignment, and this is really about creating a do not harm list, an exclusion list. It's mostly about negative screening and trying to avoid being invested in companies where you may not agree with the services or products that they provide. The second category, ESG integration, is much more about leaning to positive characteristics as well as using ESG for risk management. And when combined, the way that we look at that, that's really in an effort to enhance returns, both through mitigating risk and trying to find better performing companies. And on the engagement side, the third category, commonly referred to as proxy voting usually, but there's also space for much more active dialogue. Constructive dialogue is how we describe it. This could be many forms of shareholder activism, proxy voting, letter writing, engaging with management teams, engaging with investment managers, et cetera. And then the last, which is probably the most open-ended topic or open-ended category, would be impact investing. And impact investing is really to be thought of, at least insofar as we approach it, on a spectrum, where you have, on the one hand, more pure philanthropy efforts, and then on the other hand, where we tend to reside, which is more in the market-seeking, market rate of return seeking investments, where you're trying to create not only an attractive financial return, but also create some sort of a societal impact. So again, those are kind of the four broad categories that we think of: SRI, ESG, engagement, and impact. And I thought I'd provide just a couple quick bullet points about where the industry seems to be, at least from my vantage point, in the college and university landscape. We put forward a study for our investment committee the other month at our last meeting, and tried to assess the publicly available actions and stances for our university peers. And so we took a look at the top 50 endowments plus the Kofi cohort, which includes schools like Amherst and Williams and some of the smaller liberal arts colleges. Altogether, it's 61 institutions. And the data was interesting. Of that 61, 16 of those institutions have publicly disclosed ESG policies or practices of some sort. So around a quarter of the data set. I thought it might be a little bit higher, but that's publicly disclosed, where it's pretty obvious on those schools' websites or in their annual reports. 14 of those schools have some sort of fossil fuel divestment policies or actions, and 17 of those schools have some sort of a statement that you could access on impact investing. So I think the trend is very clear that it's on the rise. And that assessment that we performed was really of formal policies, not just casual comments and perhaps periodicals and newspapers. So, and if you look anywhere, do Google searches for ESG, the trend is clearly on the rise, especially in the last 2 years. And impact investing is also very much a very hot topic these days.
Super helpful. Alexia, maybe you can go next. You know, ESG and impact are kind of the latest terms, but, you know, FADICA and the church and the Catholic Church have been involved in this area for a long, long time. Can you tell us a little bit about FADICA and the church's journey in this area and how it all ties back to Catholic social teaching?
Absolutely. Thanks, Tim. And thanks so much, Tom, for the invitation to be part of this conversation and for your leadership. We all, as Mike said, this definitely for FADICA has been a journey. It is a journey, and we all need roadmaps and guides and peers, you know, for this kind of sharing about, you know, what has helped us along the way, and you know, to challenge each other and inspire each other along that journey. I think as Catholic Christians, we're so fortunate. You know, we're certainly we appreciate history and our tradition, and we've got a great history of this kind of work. It's both, there's some new exciting trends, but it's grounded very much in our tradition. I just want to share a few sort of real, highlights from that history reel. In the 60s and 70s, Catholic sisters and Catholic male religious too were very involved in shareholder advocacy and engagement efforts, particularly around apartheid. A lot of colleges and universities, that was also an issue they engaged in. And that work led to a number of sisters creating regional shareholder advocacy hubs around the country. And many Catholic men and women religious were part of the founding of Interfaith Center for Corporate Responsibility 50 years ago, as part of that movement. And the Catholic bishops in this country in the 90s, of course, we all know, issued their first socially responsible investment guidelines. And also in the 90s, I think there were some really inspiring examples of what we could see as early impact investing. The Catholic Bishops' Conference, through Catholic Campaign for Human Development, Catholic Health Systems, Catholic congregations of religious invested in community development financial institutions, CDFIs, which were, I think, a great example of an early kind of impact investing. And those are still very active, very important vehicles for community investment and affordable housing and just economic development. So then in 2003, the bishops updated their 1990 guidelines, and we all know now that there's a process going on now to update those 2003 guidelines. But as I reread the 2003 guidelines, I was inspired again by how robust the vision and policies outlined in that document are. We all know they call for, as Mike said, avoidance and divestment in companies that directly harm or take human life, and also outline and call for advocacy, shareholder engagement and advocacy for care for the environment, for economic justice, for upholding human rights. And they foreshadowed ESG. So this was 3 years or so before ESG was even a thing. And the bishops at the end of the document call for engaging companies to disclose social and environmental performance alongside financial performance. So that's some of our history. And then here we are today. 5 years ago, Pope Francis issued Laudato Si, which really built on our Catholic social tradition, on scripture's call to care for the earth, and had a very robust vision of kind of this inclusive economy and integral human development that, again, built on this idea that our human life is dependent on the health of our planet. 5 years later, so just last year, the Vatican issued a guidebook on how to operationalize Laudato Si, and that's when there was a clearer call for avoidance of fossil fuels and continuing to advocate for divestment from companies that are engaged in around abortion or armaments. So that's where we are now. I can talk a little more later about FADICA and our path following some of these lights in our history.
That's great. Super helpful. Hey, Tom, so is ESG all win-win, or do you give up something as an investor by investing with these ESG principles?
Well, Tim, we think it is a win-win, and I think Mike touched on some of this already. I mean, I think we've come to the conclusion with the help of our board, and we've got some people on our board who are pretty strong investment professionals, that an ESG imbued investment strategy just makes a ton of sense. And these are just good companies to be investing in, and they're going to be the kinds of investments that are going to reward their investors. So we don't think, and in fact, we've proven that I think certainly in our private market strategy, that we're able to invest in some really exciting companies that are very successful, but really have a very positive impact on people's lives.
Mike, same question. So, as a fiduciary, Georgetown relies heavily on the endowment payout that you generate. So do you sacrifice returns by investing in ESG and impact?
We haven't seen that so far in our results. And when we look at the academic literature on the topic, it's not clear to us that that that's the case. In fact, at best, we conclude that it's a push, and there might even be a lot of, although time series dependent, but certainly interesting data suggesting that it's a benefit. When we look at the application of ESG and SRI to investment results, I do actually like to focus on risk first. And I might offer just really quickly kind of three different ways to, maybe three examples to look at it in terms of how, if you weave in ESG, how it might mitigate some risks. So perhaps a very obvious one would be private prisons. Most of us would probably be opposed to being beneficiaries of profits from increased incarceration. There are two dominant companies out there in the marketplace, Geo Group and CoreCivic. These two companies are really kind of in the crosshairs of the administrations that have come, especially the Obama administration a few years ago, and then perhaps more likely to be in the Biden administration as well. That really, the revenue outlook for these companies is probably not great. And in fact, has already been declining for a couple of years. These companies are already having difficulty accessing the capital markets. Geo Group, for one example, went to the market in February and had a terrible time trying to raise debt financing. Their bonds currently yield in the 12% range. They just had to cut their dividend back in the beginning of April. And so the forward outlook, just from a financial perspective for these companies, given the relationship with the federal government, is not great. But we made a decision, and we were not really prescient on this issue. This was more in 2015, 2016, that we were not interested in being the beneficiary of profits derived from incarceration. And so we had an internal practice to divest from private prisons. There was then a formal effort that was led by a student group that then resulted in a board resolution. But and we didn't really have much measurable exposure anyway, but I'm glad that we didn't. Those two companies are down roughly 80% in the last 4 to 5 years, and are really having a very difficult time accessing the markets, and are likely to go through bankruptcy, is our best guess, in the next handful of years. So that's maybe a very obvious one, private prisons. Another big category would be fossil fuel companies, those that are extractors. It's really hard for us to guess what the forward curve looks like for oil 10 years forward. And so if you're going to invest in a private oil and gas fund where you are betting on a 10-year outlook for those companies, and then the future buyer of those companies in the next 7 to 10 years is making their own 7 to 10 year forward estimate of oil, you're talking about a 20-year forward estimate on the oil curve. And we just have no idea where oil prices are going to go. We have no idea what carbon taxation could look like if it ever emerges. It's just really hard to understand the scope of outcomes that could emerge in that industry. So we think that the forward financial risk of being involved in many of the E&P companies is high, especially compared to other options that we have in the world to invest our capital. And then let me just offer one more risk issue in terms of where it's a little in the nuance. A company like Peloton actually scores really poorly on ESG metrics. So Peloton is clearly in the wellness industry, supporting good health. However, they get the second lowest MSCI ESG rating, primarily for supply chain labor issues, as well as use of problematic chemicals. Now, the stock's been on a tear since it went public. It's up 350%. I don't know when and how those ESG factors will become an issue for Peloton. And we're not really making stock-specific bets anyway to that level with our portfolio, but I provide that as one example to say this is a company with very problematic ESG issues, and yet it's perceived in the market as this wonderful wellness-oriented company. When does the market care? So when you start taking ESG as a risk measurement factor, we think it's really interesting as an additive lens to understanding the risk of your portfolio.
Tim, could I butt in here for just a second and just to amplify a point that Mike made about risk management? I mean, I think we at CEIS look at ESG as a very critical risk management tool for us. And speaking of risk, the flip side of that is, buyer beware. The SEC and the UK Securities Authority and the EU were all looking at what's called greenwashing, which is the exaggerated claims by, now our focus today is obviously institutional. We're talking about Catholic institutions, but there's a lot of exaggerated claims about ESG and $152 billion put into what are called ESG funds in the first quarter, of 700 new funds last year. I mean, there's a lot of momentum and a lot of attention, but you've really got to be careful how you do it. And again, as Mike points out, data and measurement are really important here, and how you do that, and that certainly is going to influence the nature of the returns and the efficiency of the investing. And that's one of the reasons we put a plug in for CIS. We established a CIS Institute, which is on our website. It's the resource for people to get a better understanding of ESG and Laudato Si and all the ways these concepts interact. But I'd encourage anybody who's looking at advancing in an ESG impact theme to really, think about a trusted advisor, whether it's CIS, whether it's one of the good investment consulting firms that have specialized in Catholic clients. Because again, you want to get access to somebody who doesn't have a conflict of interest in this whole conversation.
So that's a good point. So Mike, for CIOs listening in, or board members or investment committee folks who are listening in, who are bought into these concepts, but early in trying to figure out how in the world to do it, could you talk a little bit about how, as a CIO, you've built a portfolio that's ESG and Catholic values aligned?
Sure. For Georgetown, it's probably a little different than many endowments, and that's primarily due to the way that we approach building our equity portfolio, which is the bulk of the assets. It's 70% of the capital when you combine private venture and public. And on the public side, we actually take a sector-focused approach. So we have a series of sector funds, and those sort of sit around in a core satellite structure with a couple of concentrated managers in the middle that are a bit more generalist in nature. And so it's a convenience, actually, that's our approach. We didn't build the portfolio that way to solve for ESG, but it actually allows us to solve for ESG a lot better than if we had, say, 10 generalist managers, one tackling emerging markets, one tackling non-US, a few in the US or something like that. So we just, our very approach is actually a little bit more conducive to weaning out and solving for the negative screening side of things. The positive screening is much more problematic and much more challenging. And it's a constant discussion with our managers. It's trying to find managers that are aligned with our thinking, trying to really make sure that they're weaving these practices into their own due diligence. And then on the private side, it's become a very dedicated part of our portfolio, particularly with respect to impact investing. And we might come back to that a little bit later in the conversation, but that's an area where we found quite interesting opportunities to have dedicated funds that are solving for both a market return and an attractive impact.
How are you getting those private managers? How are you nudging them towards alignment with these ESG principles?
Well, for the private funds, many of them that we are going for impact are dedicated to those areas. And so they might be very niche in their pursuit. And then on just the more generalist, be it buyout or venture capital firms, there we have a lesser degree of market pricing power. And so it's relationship, it's conversational, it's trying to engage with them on their practices and how they're looking at private companies. We decided early on that we were going to take a holistic approach, that this was not just for public companies or public bonds, that this would rather be for all of our investments across the spectrum of ownership, private and public. It's been a work in process.
Yeah.
Interesting. So Tom, how do you see this? You work with a lot of folks, foundations, family offices, et cetera. How are you seeing folks solve this and build portfolios aligned with ESG principles?
Well, I think, Tim, I mean, obviously we do a lot of the same things that Georgetown does with our managers and our alignment. We heard from the market that we heard from and again, our market is Catholic institutions, and we heard from our clients and our prospective clients that what they really, that the negative screening was great, the ESG is great, but they really were interested in many of them were interested in an impact solution, but one that didn't involve any kind of concessions in terms of investment returns. So we have a very robust, very sophisticated Catholic SRI policy, but for our private market strategy, we partnered with a firm, Hamilton Lane, that's very experienced with faith-based investing, very experienced with socially responsible and impact investing. And so we find the great advantage of private equity is we're able to target it and align well with our SRI principles and focus on things with, focus on great companies that have in the environmental impact area, clean energy transition, sustainable processes, in terms of health and wellness, digital and telemedicine, things like that, improving health outcomes, financial empowerment, those sorts of things. And these are great companies. These are what we found is that you can do really well by doing well. And so this is, and again, it's a lot of work, as Mike said. It's a journey. But we're finding great success, and we're really encouraged by it. And frankly, I was a mercenary for a long time, right? Now I work for a nonprofit, and this is a lot of fun. It's a lot of fun. And Hamilton Lane will tell you, this is the most interesting place they invest right now is the impact area, because they're just seeing so many exciting companies that are being, again, like you are, Tim, combining disruptive technology to really serve the underserved and the poorly served.
Tim, can I jump in? Thanks.
Yeah, please.
It just, as you're all talking, it inspires me. I think it would be great to have a U.S. Catholic Impact Investing Conference. The Vatican has had, with Catholic Relief Services, a series of these. The last one was in 2018. But it was an example of kind of this ecosystem that Catholic Investment Services is a critical part of. And, your work, Tom, around the Institute and all the resources you have available for folks are critical. And I think it's exciting to see this ecosystem of support growing to help Catholic investors, and the partnerships that are, emerging as well between those leaders in that ecosystem of support. Investor Advocates for Social Justice is an example of a Catholic inspired group that, for example, is a great partner to challenge and tackle the issue you mentioned, Mike, around the Peloton supply chain challenges, and to help us as a Catholic investors make that change. But we've got our journey has been both our own as a C3 organization, and we found we had to move change managers, asset managers. We couldn't really, we couldn't continue on the journey in engaging the USCCB policies as fully as we wanted to add ESG and to even consider impact investing with the manager we had. So we had to really go through a process, which was a challenge to switch. And a number of our members, like you, Tim, are really leading in this space. It's part of their vocation. So that's led us to develop our own sort of focus on this area. And we're launching a program this year and look forward to partnering, Tom, with you, with CIS, as we make that happen. But I would just affirm that this is definitely a growing interest among Catholic inspired funders, and we're responding to our members' interest to support them in the work and to connect the dots. There's some great resources, Tom, between your leadership and the resources CIS and other Catholic Impact Investing Collaborative is a great example. ISJ, as I mentioned. So I'm looking forward next year when we can all get together to a Catholic Impact Investing Conference here in the States.
That's a great idea. And let me give a shout out to, I think somebody's in our audience today, Brian Piney from Mercy Investments. And Mercy Investments has been doing this for, over 10 years. And they're So there are resources available, and I think your call to bring everybody together is a great one.
Yeah.
Well, we should have a full football stadium at Notre Dame this fall, so maybe Notre Dame could be a venue for something like that. Alexia, do you want to go tell a little bit more about the initiative you're launching in this area?
Well, it's a mission-driven investing initiative. It'll be a resource for Catholic funders, members of FADICA who are, trying to use all the tools in their toolbox to achieve their philanthropic mission, both through the charitable giving side and to also consider how, their assets in their endowment can also help them achieve their philanthropic goals and the church's mission. So we're going to be partnering, Tom, I'm looking at you, look forward to partnering with you. And also, as those two groups I mentioned, Investor Advocates for Social Justice, we have a partnership with them. They really help design, IPS investor policy statements, and help partner with you on advocacy, shareholder advocacy. So you don't have to be just a passive investor. You can really engage on that kind of issue that Mike outlined with Peloton, their supply chains that could be linked to, trafficking. And we'll be partnering as well with Catholic Impact Investing Collaborative. So it'll link these resources together for Catholic donors and Catholic foundation leaders. So we can, just be part of this emerging area and achieve philanthropic impact, looking at all the ways we can try to leverage that impact on both sides of the equation.
That'd be great. So Mike, Tom mentioned, there's great impact, but also, great companies in these investments. Can you pick an asset class and talk a little bit about how you do it aligned with ESG?
Yeah, there are a lot of great public companies that we could start looking at. Microsoft's probably one of the most forward-thinking. And if you just start getting into the data, looking at MSCI reports or any of the other companies that are involved, Sustainalytics, and there's a whole host of providers that are now in this space, each with their own flavor, by the way. MSCI looks at sort of relative ESG characteristics among industry peers. Sustainalytics looks at unmanaged ESG risks. So you have to really get into the nitty-gritty of how each of the providers do it. But MSCI gives a very high mark to Microsoft as an example. They've got a plan to be carbon negative by 2030, and by 2050 have a plan to return all of the carbon the company's ever produced since 1975, its founding, back to the earth. I'm not sure how they're going to execute on that, but if you start tilting your portfolio to some of these companies that have better practices, our hope, the holy grail, so to speak, is really that we can find companies and our managers can find companies where improving ESG practices will lead to higher quality earnings, and the market will appreciate that and reward it with probably a higher re-rating of the stock price, or a more sustainably higher rating of the stock price. And so we'll see it in shareholder prices as well, that improving characteristics on the ESG scale will ultimately lead to rather improved financial returns for us as well. I have not seen the data to support that in terms of pure causality. There's lots of data to support that there's correlation. I'm not sure yet that there's direct causality, not insofar as we've discovered in our own research. So on the public side, there's a whole host of companies that you can look at. Hopefully your managers are leading you there and biasing your portfolio. The good benefit of that is you're probably going to end up with a portfolio of higher quality companies. And so you'll miss the occasional junk rallies that occur in periods like 2003, 2009, 2021. But over the long run, having a portfolio of higher quality companies should probably outperform. And then maybe I'll provide just one specific example on the impact side. I think this is maybe a good comment too. If you're going to get into impact investing, it's really easy to just get lost in the theoretical and talk about it in very abstract terms. And I have found that it's much easier to just get lost in the anecdotes and to get lost in the examples. And so if you have any appetite for it, start learning about companies and funds and what they're actually investing in. And then when you build that mosaic, you'll start to get a sense of, oh, okay, I can see where impact is emerging. One of the areas that we chose to get involved in on the private credit side of our portfolio is we looked across the entire spectrum of renewable power, from inception of an idea for a solar farm to a fully turned on operating asset that's owned by an infrastructure fund. And we wanted to find where there was an imbalance in the supply and demand of capital. We had an overarching thesis that we wanted to create impact by having green power join the grid. But we also married that with an analysis of where there was an imbalance in the supply and demand of capital, and discovered that there was a really attractive area on the smaller end of the market for utility scale solar farms. Banks were not quite really lending in this space. And developers, once they'd had a power purchase agreement in hand, this is a contract with a utility company that provides for guaranteed offtake of the electricity in exchange for fixed payments for many years. That's a very valuable contract to have. That developer typically wants to hold all of his or her equity and still needs capital to develop the project. And so we found an opportunity to partner with a manager that provides that bridge development capital financing in the form of private credit. And for that, we're getting paid 13 to 15% gross yields. Net to us is kind of in the 8 to 10 range. And really, if you think about it, it's supported by the utility company that's backing that power purchase agreement. So you have what we think is a really attractive arbitrage return spread over that utility company's cost of capital. And because this developer is desperate to hold on to as much equity as possible to sell the project once it's completed into the hands of an infrastructure fund, they're willing to pay our high rates for credit. Now that opportunity won't last forever, but for the meantime, we've been enjoying really attractive returns. So I think that's a specific example of an opportunity in private credit. It's very niche, very focused. We think the risk-adjusted return is very strong. And we think that the impact that's generated by this is very high as well. We are facilitating the delivery of green power into the grid. Renewable power into the grid. So maybe that's, if you can go through a bunch of examples like that, if you're on this journey of impact investing, we found that to be a very helpful process.
That's great. That's great. Hey, Tom, do you want to maybe pick a company similarly in your CIS private equity fund?
So we've got a bunch. One company is called Benevity, which has expanded the reach of philanthropy and nonprofit activism through a number of large corporate communities. And that's been a very successful, and particularly during the pandemic, was a very impactful, bad choice of words, but had a great run during the pandemic. Another one is AeroSafe, which is a cold chain logistics company that's designed a very environmentally friendly way to transport medical vaccines that need to be refrigerated, and the packaging can be reused. Before, the stuff came in a big box, the big box got thrown away. Now the packaging can be reused over and over again. And guess what? We had a pandemic, and the demand for this product is off the charts because it can keep the Pfizer vaccine cold for a long time. And again, it's an environmentally friendly packaging. So we've got, Mike's right. The anecdotes are what really are compelling, because you find out these are real companies, these are real businesses, and they're doing some really interesting and fun things that are transforming. And again, the rate of change. I mean, Tim, you know this better than anybody. I mean, the only thing we know for sure is that today's not going to be the same. Tomorrow's not going to be the same as today, and the change is the only constant that we're dealing with.
Absolutely.
Tim,
Yeah, go ahead.
on the impact investing, and I'm not sure if the Dominican sisters or the Mercy sisters would, I think they call this impact investing plus maybe, but I'm aware of the Dominican sisters, a fund that they shaped called the Climate Solutions Fund, which is really, there's the public fund is, I think, still open, and that's really exciting vehicle, for impact around climate solutions. Mercy Investment Services, and I don't know as much about their fund, but they have something called the Environmental Solutions Fund. I'm sure Brian could share about that. I know he's on the call. But Sisters leadership and impact investing, especially around climate solutions, is really exciting. And I just wanted to mention one point around this kind of deeper call that some current Catholic movements, lay movements especially, are responding to, which is, just this always challenge to go further. We're seeing that continuum from negative to ESG to impact. But one example is the Focolare movement's community economics of communion, which inspired this economy of Francesco work that young entrepreneurs and economists are leading with Pope Francis to really look at how we can envision a regenerative and inclusive economy. So just to put some points on the board there around some exciting activity in our Catholic world.
So that's awesome. So before we turn it over to Zella for audience questions, one last question. Maybe Alexia, you could bring us home here. Folks have a lot on their plate right now. Why is ESG something that should get big focus right now from Catholic universities and Catholic foundations?
Well, I think Mike and Tom said it really well on the risk reduction. If it's really important from a risk reduction point of view. So there's just the practical thing, practical matter. And then, I said to a friend the other day, we just look around us, the signs of the times of this pandemic, of climate change are right there in front of us, which are, which in a way conveyed us the message of Laudato Si and Fratelli Tutti, that we're all connected globally. Our sisters and brothers in India, if they're not vaccinated and can get better, they're really pray for them right now, and other countries that really don't have access to the vaccine we have, that we're all going to suffer. So we're all connected, and we're connected very much to the health of our planet. And, we don't need to just read about that. We can just, look at the news every night and read the papers, and we see that reality staring us in the face. So it's both risk reduction and how can we be part of the change that needs to happen. And I think, young Catholics and young people on our campuses are giving us great inspiration, as well as people like Tom, you and Mike are as well in providing this leadership. So it's the urgency of the moment, I think, is what's calling us, and our faith's kind of very clear call to be part of the solution and put our, align all of our assets with our faith's values.
Zella, do you want to take over and ask the audience questions?
Great. Thank you so much. This is such an interesting discussion, everyone. And we have a lot of questions. There were two questions directed directly for Mike, so I'm going to start with those. Mike, folks want to know if you can repeat the stats around the universities and those engaging in ESG investing. And can you elaborate on the data and stats around percentage engaging in ESG? And also, folks were asking what percentage of your endowment at Georgetown is aligned with ESG, and what was the biggest hurdle in implementing that?
So on the data, what our team did is we just went to that set of 61 universities and colleges and scraped for the annual reports, whether or not the investment offices had websites, and any evidence that there was a formal, publicly available document that really addressed whether or not that university, that institution, was engaged in ESG practices with their endowment. And so of the 61 schools that we looked at, 16 had some sort of a documentation. This was done back in the fall of last year and into the winter, so that number may have moved already. Hopefully it has. But 16 had what we could find. And then there were 14 that had some sort of fossil fuel divestment policy in place, of which 6 were either at or pretty much just shy of, but close enough to full divestment from fossil fuels. And then there were 17 that we found that had some sort of statement about impact investing. We also scanned for diversity, but that's a sort of Venn diagram related, but slightly separate topic. We've been involved in diversity for a number of years now, and publish on our website the diversity statistics for all of our investment managers in aggregate, not by name, but in aggregate. So that was the data set. A little hard to measure the precise percentage of the endowment that is in impact investments because it cuts across efforts in the public funds as well as private funds, but enough to be on the radar of our committee, so well over 10%, and enough to matter in our view. When we surveyed all of our public managers, all of our managers, not just a public one, but all of our managers for this most recent investment committee, 55% of our managers have what we would describe as well laid out, thoughtful ESG and SRI policies and practices, which means 45% don't. So now of that 45%, many just had not put that into a codified formal document, but they were part of their practices, but we decided to cut the line off at whether or not there was something formal. So by that cut, we've got some work to do. In terms of the hurdles, you know, I work for a university, we've got shared governance, we have a lot of constituents, board members, alums, students, faculty, leadership, so many people to engage with along the way. Our students definitely initiated this conversation with us back in 2013, initially around fossil fuel divestment. It took us a while to get there. In 2015, we put together a board working group, and that was led by the chairman of our board at the time, Paul Tagliabue, and it was a very intense effort with several board members. And that came up with the creation of a brand new social responsible investing policy, which is on our website if you're curious, investments.georgetown.edu. I'd say the biggest hurdle was really the fossil fuel divestment effort. We deliberated on that one for a long time, years. And we finally came to a decision in the early part of 2020, which feels like a lifetime ago, to go for full divestment. And we had many constituents to consult with and engage with. We have a campus in Doha, Qatar. So, you know, we have interesting constituents in the Georgetown universe. Where we came out was that we are pursuing a full divestment plan. We've given ourselves 5 years for public companies and 10 years for privates. We hope to be through that much faster. We also afforded ourselves a little bit of flexibility for situational awareness of whether we have commingled funds and it's not practical to extract yourself from those companies immediately. And so there's a little bit of flexibility in our policy, but I think that was the biggest hurdle that we had was getting through the fossil fuel divestment campaign.
Mike, it's funny, one of the questions was, what's the USCCB's view on fossil fuels? And I don't know if you can quickly answer that question before I move to Tim, because we have a bunch of private equity questions.
I don't know. I'm very hopeful that they'll include a very heavy emphasis on this in the new policy. I'm not connected to them in any formal way, so I don't know. Laudato Si was a very large inspiration for us, and it really helped further the conversation within the university. And I know from my own thinking, it was really another one of the many catalysts along the way. Climate change has taken a very large effort for our thinking and our focus on screening. If we don't get climate change solved, a lot of the other things won't matter. And so I would say that's probably on a slightly higher level for us than other issues. But I'm not sure. I'm very curious to hear what they come up with.
True, but the Pope's views are very clear, right? He wants us to take care of our Earth. Tim, we had a few private equity related questions, and I was wondering if you can give us an example of how you invest with ESG principle in venture capital. If you can give us an example or two.
Yeah, sure. Venture is actually a fascinating area for ESG because most of the talent in our startups are young people. And the biggest challenge in a startup to being successful or not being successful is, can you recruit great talent? And young people want to work for companies with mission like never before. So my companies that actually have big social impact have a much easier time recruiting great talent. One example would be a company I co-founded and seed funded a number of years ago called Chime.com. It's a company you've probably seen TV ads for now. And you'll be able to invest in it as a publicly traded company here shortly. But what we saw 7 years ago before we started that was that about 2/3 of American families struggle to save $500 in emergency savings. It's pretty bleak out there for many families. But the big consumer banks, B of A, Chase, Wells Fargo, et cetera, they charge consumers, the poor consumers, the vulnerable consumers, about $500 a year in a combination of monthly account maintenance fees and overdraft fees. So even though the big banks make only about 3% of their net income on those monthly fees and overdraft fees, they cause millions of American families to not be able to make it to payday. So you're a couple of days away from payday and you overdraft and they charge you a big fee right at the time when those families just need a few days of float of help. So what we did was we started a bank. People thought we were crazy at the time. No other VCs seemed to be interested in this category. And when I funded it, now everybody and their brother loves it. And it's getting overfunded. But we started a bank that basically used a smartphone app and a debit card. So it's kind of the Amazon version of a bank versus the traditional bricks and mortar banks. We didn't have to charge any monthly fees or any overdrafts. And we added a feature that if you get close to payday and you can't pay, and you got some direct deposit history, we'll actually spot you the money to make it to payday and then recover it back when your paycheck comes in. So it helps people versus hurts them. And because it's so efficient using the internet, the gross margins are amazing without charging those big fees that the big banks do. So when we started, it was bleak. Nobody else believed. I probably had to introduce it to 100 plus investors on the 3 rounds after I funded it. And then all of a sudden we got to a number where people believed. And then now, gosh, too much money's gone in. Over a couple billions now been invested. And the company will be publicly traded soon. Folks are talking about a 30 billion ish market cap on IPO. So here's a big bank that that started out as a little bank just a handful of years ago. That's helping millions and millions of American families be able to save that $500 a year in emergency savings.
Wow, that's a great story. We have some. Go ahead, Alexia,
I
please.
just wanted to offer clarification. I think on this Catholic idea for Catholic Impact Investing Conference in the US, SEEK is really, I think, working on that. So already. And so if there's interest, just let us know and we'll connect you to them. And there could be a broader conference as well around that, for general mission-driven or faith-consistent investing in the Catholic space as well.
Great. We have a series of questions on SDGs and how you folk source ESG data, and what's your view on the wide dispersion of scorings in ESG data and analysis by various suppliers. How do you handle that? Mike, I think maybe this question is for you, and please, the others chime in.
It's very popular to frame your impact goals along the lines of the UN SDGs, the Sustainable Development Goals, and we've taken a very hard look at each of those, and I think they're admirable and interesting. We've not decided to anchor ourselves to those. We use them, but they're not our binding framework. On the ratings providers, I think it's really important to just get into the data and understand that each of these ratings providers are trying to come at it from a slightly different angle. They're not exactly apples to apples. You've got to really understand which one is going after which lens to look through. I mentioned 2 of them before, Sustainalytics and MSCI, very different approaches. And so it's if you just draw a scatter graph trying to look at a regression analysis of ratings from one to the other, a lot of it looks noisy. And low rating on one company there might be a high rating on another from another rating provider. You can't run the data that way. You've got to look at the nitty gritty of how those ratings are calculated.
So true. We have a question from Ted here. It says, how can smaller Catholic portfolios, religious orders with under 20 million in assets get involved with private equity and or debt investments? And this question is for Tom, but feel free to call us, by the way, email us at info@catholicinvest.org. We'll be happy to get into more detail. But Tom, I don't know if you have anything to add. We're getting close to the hour mark here.
I think that the challenge for a smaller Catholic investor with assets under $20 million is really an asset allocation and suitability issue, which is, should they be committing making a commitment to the private markets where they're going to have to they're going to give up some liquidity, and I think we've got some hoops you've got to jump through. But one of the premises of CIS is to give Catholic investors of all sizes access to the very best managers, and so we through our impact funds have tried to provide access for smaller Catholic institutions into a bigger private market strategy.
Great. And we have so many more questions, but we're running out of time here. I don't know if folks want to add anything. Tim, Alexia, anything you want to add before?
I just saw some questions on USCCB and fossil fuels, and the current
Yes.
guidelines do call for investment in clean energy and renewable energy technology, and to engage support policies to promote those renewable and clean energy. And it does not call for, as Mike said, divestment. The new policy, we don't know what the new policies will say, but the Vatican's guide last year does call for divestment from fossil fuels.
On that topic, I just want to add one point that really got me to sleep a lot better at night when thinking about it, is that we just decided, or our team decided, that we'd rather not be beneficiaries from the extraction of fossil fuels. We'd rather be beneficiaries for solutions for climate change. And so we found a place where we're not casting a judgment on the sector. We're not casting the players in the sector as evil. They're required and necessary for modern society to continue. We all know that. We'll be on fossil fuels for many decades to come. But I think that our capital can be transformative to help in our small way bring us to that change where we need to transition off of a carbon dependent economy into one that's more sustainable.
Mike, that's been our experience exactly, which is particularly our the private markets have offered Catholic investors a way to pivot from fossil fuel into emerging energy technologies. So it's been a great, again, not focus on the positive, not the negative.
Yeah.
So Tim, thank you for this idea and for your leadership today. Alexia, thank you for participating.
Thank you.
Mike, thank you for everything that you contributed to the program. We'll do our best, the audience will do our best to see if we can answer some of the unanswered questions and gather some information and be responsive. And Zayla and the CIS team will be following up on that. But again, thanks to our great panel, really a great session. And again, Tim is going to be kind of anchoring a series of these sessions on impact and ESG themes. So we're grateful for his leadership on this, and we're grateful to our audience for participating today. And please all be healthy and safe. And I think this concludes our program. Thank you again.
Thank you.
Thanks, Tom. Thanks, Tim. Thanks, Alexia.
Thank you.
Tom. Thank you, Tim. Thank you, Zella.
Bye-bye.